Applying for a mortgage can be extremely exciting and, let's face it, terribly terrifying all at the same time. Who likes rejection? Last time I checked, most of us don't really like it. But if for some reason your loan approval comes back rejected, let's talk about the next steps to take. My name is Andrew Finney, and my passion is helping you make sense of real estate. If you need help finding a top agent near you, or if you simply want to drop me a line to say hello, my contact info is below. If you're new here, please go ahead and subscribe to this channel now and like this video. Thank you. All right, my friend, let's take a closer look at this. To put this in context, the Federal Reserve actually conducted a study and found that 1 in 8 people that apply for a mortgage get rejected. This works out to roughly 12.1%. Let's figure out why this happened to begin with the first point being 8 common reasons for mortgage application rejection. The first reason is insufficient income, length of employment, or documentation. The second reason is that your credit score does not meet the lender's minimum requirement for the loan program. The third reason is that your debt to income ratio is out of whack and does not meet the lender's minimum requirements for the loan type that you applied for. The fourth reason is having a bankruptcy or a foreclosure in your history and not enough time has passed yet from the date of discharge. The fifth reason is a low appraisal on the property that you went into contract on. If that happens, the lender might deny the application for insufficient funds. The sixth reason is having a lack of a cosigner if it's required and needed in your situation. The seventh reason is having missing information in your application. You might be missing documentation, you may not have all of your tax returns ready to go, your financial statements, or your bank account information ready to go. The eighth reason is having insufficient funds available for your down payment and buyer closing cost. Now, if the problem is not having enough money for the down payment, that's something that we can easily resolve by saving up more money, looking for down payment assistance programs or no down payment programs that might be amenable to you. And it's best to chat with a local loan officer to review all of your mortgage options with you. Now, if the credit score is a problem, that's an entirely different animal, and sometimes that takes a lot of time. It can take 3 months, it can take a year, it can take even 2 years to boost a credit score to the lender's minimum requirement to ensure everything's on the up and up moving forward. If that's the case, then you might want to visit Integrated Loan Assistance. The people over at Integrated Loan Assistance will be more than happy to review your situation with you to help you rebuild your credit. This is where a credit repair specialist can be your best friend and get you on the right track. Now, I know there are some good ones and some bad ones out there, and for reference, Integrated Loan Assistance is a company that we use here in Las Vegas, Nevada, a lot with the loan officers that I work with, and while they're not based out of Las Vegas, they span the nation to provide assistance to people looking for meaningful ways to boost their credit score. So if it's right for you, why not check out Integrated Loan Assistance and see what kind of options and help they can provide you. And by the way, no, they did not pay me for that endorsement. It's just something that I have observed with the families that I work with here locally, and it has worked extremely well, and I'm hoping it can work well for you. The second thing that you can do is work on boosting your credit. So you're more than welcome to talk to the professionals ready to help you at Integrated Loan Assistance or whatever credit repair company that you have in mind that you want to work with. What they're going to do is take a deep dive into your credit past and see what went wrong and what went well, and make suggestions to you that are going to be the most meaningful. They can assist you in getting what's called a deletion letter from any creditors or collection accounts that you might have. They can advise you as far as debt restructuring if that's something that's going to be amenable to your situation. At the end of the day, boosting your credit score is going to lead to a sound financial decision and make you even more well prepared when you apply for your mortgage the next time around. The third thing that you can do is reduce your debt to income ratio. Now, that might be something that unless you had a really interesting conversation with a loan officer, that you might be wondering, what the heck is a debt to income ratio? Well, I'm glad you brought that up. So let's talk about it really quick. Perhaps the best way to understand a debt to income ratio is with a simple example. Now, let's say that you earn $5,000 a month and you have $2,500 a month in debt. If you took the $5,000 and divided out by 2,500, you'll come up with a result of 50%. That 50% is the debt to income ratio off of that figure. Now, if there's something that you could do over the next 3 to 12 months to maybe reduce your monthly debt load from $2,500 a month down to $1,250 a month, then what's that result going to look like? So then again, we go back to the $5,000 a month that you earn and you divide it out by the $1,250, and that gives you a result of a 25% debt to income ratio, which now makes it much more attractive for a lender to give you a mortgage. Of course, another way that you can offset your debt to income ratios is simply asking for for a raise or getting a promotion at work. At the end of the day, if we don't ask, the answer is always no. So by virtue of just simply asking the question, you might just get a yes and increase your pay along with it. Still stay focused on paying down your debt. It'll lead to a strong financial future for you. The fourth thing that you can do is stay optimistic and plan for your success by becoming educated. By the way, you did a great job just by clicking this video, and I'm super proud of you and excited for you. So now, think about what your next steps are and plan out a good course of action for you. To help you get started, let's talk about debt to income ratios and why they're so important to you. Then let's chat about a relatively painless 5-step financial plan to help you buy a house. Looking forward to our next conversation. We'll see you in a few.